U.S. authorities are turning their attention to FTX Nishad Singh. FTX bankruptcy filings show a $543 million loan to former engineer director Nishad Singh, who is purportedly a part of a secret wire fraud chat group. U.S. closes in on Bankman-Fried inner circle with probe of FTX chief engineer. And I want to show you guys some of the details here. The exact scope of the probe into Singh's role and activities at FTX isn't known. Bloomberg News last month reported on documentation that showed a GitHub account bearing Sid's name and authored code that hid Alameda's ballooning liabilities. GitHub is a repository that companies and individual software developers use to store and share code. So one thing that I think is interesting about this is we've been talking about this for a long time. Some of the executives at FTX have already essentially turned on Sam, pleaded guilty, and essentially made deals. We have not heard of from other executives, and people have been asking, what's going on with Singh? And I mentioned his name before. Evidently, his name is on the code right over at GitHub, so he may be working with the feds, and that's sort of what the rumors have been. There are other execs that could also be included in FTX as well. My general thoughts on these things are it's going to be pretty scary out there for people who have money in this stuff. Some of the money may be gone, as you can see here. Singh, it was like $543 million, loan from Alameda that may never ever come back. That money, obviously, someone wants it, of course. And I read this kind of thing. For example, Genesis, for those of you who may not have money in this stuff, is saying crypto lender Genesis considers bankruptcy, lays off 30% of staff. I mean, it just. I don't know. I don't know why you would want to put your money in stuff right now, or at all, to be perfectly frank. I've never been a crypto bull, and even something like this. Silvergate race to cover $8.1 billion in withdrawals during crypto meltdown, and you're just going to keep hearing these kind of stories. So, I do see in comments they'll say, Chris, why aren't you, in love with crypto? It's because of these reasons, and the other reason is I always say the same thing. Manage your risk, and for me, it's like, why take the risk? Other world in terms of sort of like what's going on in the markets, there was another major sort of bankruptcy rumor going around. This time it's Bed Bath & Beyond, saying prepares to file for bankruptcy within weeks. So this is sort of a rumor, but I wouldn't be shocked, because if you guys remember, it was a few months ago where the Bed Bath & Beyond, it was like the CFO fell from a building in New York City and ultimately died. So I think the situation was quite dire. As it is, and I'm not making jokes or anything about this. I'm just saying that I just remember this kind of stuff. So that's what's up with that. The biggest news, though, today in terms of markets, and all these things are big news, is actually what the Fed is signaling. So every now and then, someone from the FOMC will basically come out and say, hey, everyone, this is sort of our plans. This is what we're talking about. This is what I'm thinking. And they pose it as being their own opinion, but they're giving national TV interviews on CNBC. And basically, this is Fed Esther George, and she was saying, what? I think rates are going to be above 5%, and going to be 5% longer than you think. So they are signaling hawkish, and they want people to take them seriously. And so, obviously, markets are going to react to that. But this is the kind of stuff that you want to pay attention to. I just give you guys a simple example. I keep getting emails from various bank accounts saying, hey, just regular savings accounts is like 3-4%, that kind of stuff. And so, if you're managing your own money, which probably you are, why take the risk of throwing all your money in the market when you can get like guaranteed money just on a savings account, let alone CDs and bonds and these sort of things? And so someone asked me before, any sort of commodity recommendations, this sort of stuff. I just say, be diversified, look around what your opportunities are, and manage your risk. That's the best thing to say. And understand, though, that when the Fed is raising rates, it makes it tough for stocks. That's just the reality, because there are other choices and chances out there. If you want a general sense of sort of where we are in the market, and then this is just a general guideline, you guys can look at this stuff for yourself. But this is the S&P 500 PE ratio, right? So it's the price of stocks compared to how much companies earn. We're currently sitting at 19.81. We used to look at this every single day, but people always say, Chris, you're so crazy, numbers don't matter. and in a crazy bubble market, it seemed like not, right? It seemed like I was the crazy person. But however, obviously, it has come down quite a bit, and you can see the spikes there. But at 19.81, the mean, over time has been around 16. The median's been around 14.91. So, trading at 19, 20-ish, it's a little bit high compared to history. You can look at the Buffett indicator, which looks at the market value of all the stocks compared to the GDP. This would suggest we're 23% overvalued. You can take a look at another way to look at the S&P 500 PE ratio, and this would suggest that we're 37% overvalued. So, take the stuff with a grain of salt. Just have a general sense of where we are. The reason why I say grain of salt is because remember that these numbers are based on the past, right? And no one necessarily can predict the future. Basically, what you're looking for is you need earnings of companies to go up in order to, essentially justify their prices / valuations. If earnings of companies go down, stocks are really going to feel a lot of pain because then the PEs would rise. And generally, you want to have PEs that are around the earnings growth rates of companies. So this is sort of what we're experiencing slowdowns because the market, the interest rates go up, it slows down all business activity. Companies start reducing their forecast. They come and report earnings, whether or not they're good or bad. And we see, news of Apple slowing down or Tesla slowing down, stuff like that. It gives you a general sense of what's going on in the market. We talked about politics in a separate video. You can check that out. But basically, we still have not chosen the Speaker of the House. It's a crap show over there. And see my video on that separately. But yeah, that's what's going on. And we still don't have one. There was a funny article that I saw this one, the headline. I got to read it to you guys. It is Tesla isn't Apple, Elon Musk isn't Steve Jobs, and its cars aren't the next iPhone. That was pretty mean. But it was interesting. So this was a pretty aggressive article, and the basic gist is saying, this is not Apple and Steve Jobs, and essentially people really wanted someone to replace Steve Jobs as being, a prolific CEO type dude. The language they use in the article is a middle-aged white dude, but I know some people get offended when you say that kind of stuff, but I'm just telling you that's what the article language was. That there's some people who have that need for this sort of Tony Stark kind of character, and the reality is in terms of this sort of thing, it's true. Tesla's not going to be Apple, and Elon Musk isn't Steve Jobs. I know the Tesla fanboys and fangirls get upset when people say that, but the reality is it's just like something like an iPhone. Theoretically, everyone on the planet could have one. I'm saying theoretically, but for everyone on the planet to have a Tesla, no, they're not. It's not that kind of product, right? If Tesla theoretically got into the phone business or the watch business or something that we could all, literally use, children as well, sure. But Tesla is a bit of an expensive car, and not everyone's going to have a car, and not everyone's going to have an expensive car, right? So for the fanboys and fangirls out there, that part was always strange to me, that they thought they were going to, rule the world. And then the other one, which I thought was interesting about the article, they made the point that something like a Toyota, which is like, the biggest car manufacturer in the world, they have like 10% market share. So this idea that Tesla would ever have like a 50% market share, like something like, say, Apple could command in various product categories, is just ludicrous. Now, I get it. Fanboys and fangirls would say, no, Chris, you're all wrong. Tesla can, have full market share. Forget 50%. We're going to have like 90, 100% market share. But I just, you guys know my feeling with that. I just keep it in reality. So it just... And obviously the stock has been coming down, so it should be obvious that we were right. But it is what it is. It looks like that they may have a demand problem though in China. They're cutting prices. This just came out just a few minutes ago. I was looking at this, so it says Tesla slashes Model 3 and Model Y prices. Now I know people get upset when you read the news, but I'm just reading the news to you guys, and you can make it what you want. The other one is COVID is still in China, as you guys see, and it's been affecting their factories. And so one of the things that was really interesting, this was sort of the big news today as we're recording this, is that China's changing their policy. So they've been doing a couple things. They've been signaling that they're going to be looser on their tech. So some of their tech stocks have been rallying. Who knows? Chinese stocks are a bit like the lottery. It's all of the whims of the government. But yes, if you were trading these things, you could have done well if you've caught the exact bottom. And whether or not this is the top, who knows? You could have done really quite well. But the government just sort of operates on a whim. And this one is interesting because the reason why I mention this is you can read the headline. It says, China may ease the 3 red lines property rules in big shift. And essentially what it is, they're basically giving sort of the green light for real estate developers to basically leverage themselves to borrow more money. And it's kind of odd. I understand that you want to, I guess, re-encourage growth and stuff like that, but we're still kind of in the midst of a meltdown where people aren't paying back what they already owe. So I'll read the details. You guys can see what you think and get your own opinion as well. It says here, China is planning to relax restrictions, right? Talking about relaxing restrictions on developer borrowing. That's what I'm talking about, leverage, right? So make it easier for property developers to borrow. Dialing back the stringent, quote, 3 red lines policy that exacerbated one of the biggest real estate meltdowns in the country's history. Beijing may allow some property firms to add more leverage by easing borrowing caps, right? The limit that you can borrow. and push back the grace period for meeting debt targets set by the policy. According to people familiar with the matter, the deadline could be extended by at least 6 months from the original June 30th date. And it's interesting because they had this chart here that showed which companies are over the red lines, meaning that they set limits on basically how much you can borrow. And Evergrande was like way over the limit. And I don't know. I don't get this one, guys. I really don't. I don't get it. I understand that they want to get the economy going again and stuff like that, but they haven't really even recovered from the current meltdown they're already in. So I don't get this one. And I guess theoretically that they think that the COVID is going to hit the country so hard, be it factories and stuff like that, they got to figure out a way to stimulate the economy. But you're dealing with it just borrowed money on top of borrowed money on top of unpaid borrowed money. So it doesn't make sense to me. I understand what they're doing, but I don't understand the rationale, in my opinion. So love to hear you guys' thoughts on this one. There was a really interesting article as well, and it was funny because the way they wrote it, and I'm sharing with you, is they wrote it that this generally only affects upper management kind of people. Senior developers, this sort of thing, or vice president, stuff like that. But basically, if you read the headline, it says FTC proposing banning non-compete clauses for workers. So if you don't know what this stuff is, so basically, let's say, for example, here's a good example. You get a job at Google Waymo, robot driving kind of stuff, and you work there for a couple of years, and then you quit or whatever, and they may have a thing in your contract that says, hey, you cannot go work for one of our competitors. No BMW, no Tesla, no anything developing automated driving, and so then you're kind of like screwed for a couple of years. But if you're that kind of level, you probably have plenty of money as it is, but most likely. But it's interesting because they were making the case here, and this is the FTC. They're talking about changing these rules and this stuff like that. Is that it basically hinders growth and hinders innovation if you don't let workers freely move around. And I think companies would likely be against this. It's an interesting one because obviously, if you're a company and you have some sort of proprietary technology, something like that, you don't want people with knowledge of said technology to just go spread it around to competitors. But then if you're said competitors, you do want to get this technology. So I guess I'm just talking out loud. I guess by removing this kind of ban, it would probably benefit the smaller companies, maybe hurt the bigger companies more. Also, too, they were saying in some cases it affects people wrongly to where, for example, maybe there's a lower worker that didn't really even have access to the full technology, but in their contract, because they were kind of part of that department, they're unable to work for competitors. So I think it's an interesting one, and I'd love to hear you guys' thoughts on this thing. That's it. The other one is as well is I did a separate video on this. I do cover sports from time to time. This was the basically with the injury to Damar Hamlin. So they're actually going to cancel the game. So this was between the Bills and the Bengals. So the Buffalo Bills and Cincinnati Bengals. And I guess they're just not going to play it again. And if you saw the ending of the game where he got hurt and there were players crying on the field, and it was actually, it's pretty scary. I don't make any jokes from that. It was really scary. And I think that was the right move to cancel the game. That's it. So anyway, thanks again for watching. Love to hear your thoughts on any one of these stories. And this has been your daily news.